Hey everybody, this is Craig Moser. It is the 13th day of January, believe it or not, already, 2021. Crazy, crazy, crazy. And this is a few minutes that I wanted to cover some things about the market and economy and sort of have a good discussion with you for today. So if you will bear with me, we're going to share a little bit of information. So quick look at the stock markets. You know, the stock market has been on a pretty good path ever since the crash. So this was about a 33% decline right here. And that ended late March of last year. We reached recovery point around here, which was about July of this year. And I'm sorry, November of this year. And since then, we've had a fairly decent run in the S&P 500. When we look at things like the Dow Jones Industrial Average, it is a similar chart, not as much upside because you have some stocks in here that are creating some downward pressure. You know, you still have oil, although oil is improving. You still have companies like Boeing in here. And so just recently, you've seen some of the financial stocks start to pick up. That's kind of why the Dow is working. And then if you look at the NASDAQ, which has been the strongest of the three, NASDAQ had a milder decline and a much more substantial incline because this is where most of the tech and the biotech is housed. So that's always a good thing if you're looking to be a investor. You're trying to go where the money's going, and that's where it has been going. So bear with me a little bit as we look at these indexes and understand they're pretty darn expensive right now. So let's look at a 5-year picture of the NASDAQ, and you can see what I'm trying to say. So 5 years ago, over here, and today. So what is sustaining this upward movement? Well, obviously more buyers than sellers and money. Our government has embarked on a big money print. We've had 2 fairly significant money prints last year, and I believe that there'll be at least 2 more. So stimulus money going to the populace. A lot of people are staying home and day trading. A lot of people are trying to go into DraftKings or buy Bitcoin or something like that and increase their net worth. Has it worked so far? The answer is yes, it has. Will it work forever? Absolutely not. So those are some of the things that I wanted to discuss today. So stock market in the US, if you look over a 5-year window, great. If you look at the S&P 500, pretty great. Okay, not as good as the NASDAQ, but pretty great. And so now let's look at some of our other countries. So we'll look at China. MCHI is one that I can use for China. And China's pretty good looking chart there. If you look at Europe, Australia, and the Far East as a index, EFI, if you will, not too bad over 5 years. Right here we were in 2018, and we're back to those highs. So is that good? Yeah. It's always good to make money in the stock market. So understand there are points in time where things work really great, but you have to also be cautious of the fact that, especially in the United States, stocks are kind of expensive and they can drop. If we look at bonds, weird stuff happening in the bond market this past 12 months. So here is a 20+ year treasury. What I'm wanting you to see is the long end of the bond market starting to drop some. That means that longer maturities are starting to actually have some higher interest rates than they had 4, 5, 6 months ago when they first had to drop interest rates on the floor, if you will. So understand there's a lot going on in the markets right now. It's not a normal economic environment. The Federal Reserve and the U.S. Treasury have done massive stimulus to try to get us and keep us on, sort of level footing, if you will. So be aware that it's not a normal world out there. If we looked, say, at the dollar, for example, We can pull the dollar up, and the dollar over the past 12 months, not so up. So if you're an exporter here and selling stuff over to Europe or selling stuff to Australia, Canada, one of those countries, your stuff's cheaper than their stuff. But if you're trying to buy something, their stuff's more expensive because the dollar doesn't buy as much. Pretty easy to understand. Gold. As we look at gold, yeah, gold really hasn't made a new high since back in here, which was about July. Okay, it ran up, and since then it's sort of been making lower highs, if you can look at it the way that I do. And so understand that, you know, people are asking me, should I buy gold because they're concerned about all this political turmoil? And the answer is only if it's going up. Because, you know, if it's not going up, it doesn't pay a dividend, it doesn't have any earnings, it's a piece of yellow metal. Buy it if it's going in an uptrend, but don't buy it if it's flat or going in a downtrend. It's just another asset class to us. When you look at what is happening, say, in the industrial metals part of the world, that's an interesting thing that's starting to finally pick up. If we look at energy as a group, here's an index. You can actually buy Fidelity's Morgan Stanley Citigroup Index Energy Index, and you can see energy, which would have both the oil companies and utility companies in there, has just started to move back up, primarily the oil ones. So if we're looking at companies like Exxon's been on a downward trajectory for a long time, hasn't been able to make any headway, and then all of a sudden you see that starting to perk up a little bit. Interesting to look here. Why? The commodity price is starting to go up. If you look at what you're paying at the pump, it's still not painful, but it's not as good as it was in the summer. So just understand, as these commodity prices go up, the values of the Chevrons and the Exxons will start to improve in price because they are able to have a better profit. These companies, especially the two I just showed you, do upstream, which is where they go hunt for the oil and stick a pipe in the ground and pull it out. They do the refining and processing, and they do the midstream in there to do the pipes in between there, the transport. So these are sort of the whole shebang, whereas some of these other companies like Phillips 66 or what have you, you know, which has been down a long time and working its way back up, they just do refining. So as more oil comes through the pipe, these guys will make it into diesel or nat gas, not nat gas, but you know, gasoline or kerosene or whatever they're refining for us. I don't know how to just say this, but be more cautious right now. Because if you look at market highs and try to say, okay, buying stocks at the top of the market, you have to see these stocks go higher to make any money, to make it simple. I mean, that's fairly intuitive, but it's not as easy as it was when we were buying them back down in here. That's the easiest way I can say it. So stocks are not cheap right now. Most of them aren't. And so be cautious of what you're paying for one with the hope that it'll go higher. You know, tech, I'll give you an example of Zoom. Zoom's been a real high flyer. We're on Zoom right now. And so it peaked out over here, and it peaked out at about $588 a share. They have kind of not so high earnings, but when it started last year, it had negative earnings. So now they're making money because of what I'm doing today and thousands of others. The stock peaked out at $588. It's $371. So that's what can happen to your, you know, high flyer stocks if you're not careful and pay a lot of attention to them. Now, when you look over here on the left, the reason why I bring this particular stock up is you're paying at $371, 263 times what its trailing earnings are. So it has to earn 263 of these years in order to equal the price that you're paying. And that's just a way to think about it. So at the end of the day, these stocks are not cheap. Be kind of careful. If you look at, you know, the big names, you know, it's always Apple. So Apple's not overly expensive, but you're paying 39 times what they earn. If you look at Amazon, which has really come down a lot, but you're still paying over 90 times what they earn. If you look at Facebook, you're paying 29 times what Facebook earns. If you look at Microsoft, oh, can't type, you're paying 34 times, and that's a little on the pricey side. That doesn't mean it won't go higher, but just understand that you're not getting a bargain on these stocks right now. You're just hoping that they go higher than where they are. If you look at Google, last one, FANGs, Google, you're paying 33 times earning. It's not too overly priced, but still kind of pricey. If you're looking at buying them, you want to buy them when they're down, not when they're up at the top. All right, so I don't want to bore you to death. I will talk about bear markets for just a minute, because if I didn't, I wouldn't be doing my job. I want you to understand that sooner or later, there's going to be a bear market. Now, let me give you my definition of a bear market. A bear market is a market that has a decline greater than 30%. So we had one last year, but it didn't last very long because they printed a bunch of money and injected into our economic system. But if you look back, there have been, since World War II, there have been 12 bear markets that have averaged a decline greater than 30%. And typically it takes 14 months, so a year and 2 months, for that decline to quit declining, if that makes any sense. And typically it takes about 24 months or 2 years for that market to recover back to where it was. So you could use 2008, you could use 2000 to 2006 for that market to come back, actually, and use those sort of as your benchmarks to say, okay, those were severe declines that lasted for a prolonged period of time, not something that was over with in 4 or 5 months. So one of these days, and it's not too far in the future, you're going to see that occur. And I'm just sort of giving you, Craig said it, so pay attention, and it's probably sooner than later, simply because of the price, not because of political unrest or because of economic failure or anything like that. It's just we're overdue for one of these corrections. So don't be overconfident buying high-flying tech stocks, I guess is the easiest way to say it. Okay, I'm going to end up for today, because otherwise I'll just bore you to tears. If you have questions, as always, give us a call right here at Maestro, 336-448-1086. We have a lot of information on our website that we'll give to you. Sign up for our newsletter. And with that, I will let you go. Have a great rest of the month.